Okay, it's showtime. Hi, folks. As you know, our topic today is Annuities 101, Safe Money Planning. And I have to say, this is a really popular topic because so many people today who either are retired or are about to retire are looking for safer ways to invest their money. And of course, annuities, because they are usually principally protected, many times come up in the conversations with their financial advisors. And hold on, sorry about that. So because of that, and the varying opinions that many financial advisors have related to them, many people are confused and hesitant when it comes to annuities. So because of this, I thought it was time for us to tackle this topic in order to give my perspective on annuities, because every financial advisor should have an opinion on them, whether it's good or maybe not so good. And I certainly am no exception when it comes to that. Now, that being said, right out of the gate, I just want to say that it's been my experience that every single financial vehicle out there today has a time and a place where it can be a good option for a client given whatever their specific situation is. So to me, it's not ever really been the matter of whether some types of annuities are good or bad in general. It's really just been whether they are right or wrong for any given situation or not. For instance, I personally have never written a fixed immediate annuity for a client. This is the type of annuity that in order to get the very highest payment possible, the assets that are invested become irrevocable. This means that once you sign on the dotted line, that's it. You start getting a check every month for life, but you can't get your money back no matter what. Plus, to get the very highest monthly benefit from one, the annuity usually has to forego leaving a death benefit to the beneficiaries as well. However, that does not mean that those terms are unacceptable in every situation. Now, this is only one of many types of annuities, and it's the only one that works like that I know. However, I did consider writing one for a prospective client one time because she was 80 years old with a life expectancy of around 85 to 87, and she needed the very highest monthly benefit amount possible. Plus, she had no significant relatives to leave her money to either. So in my opinion, she was the quintessential customer for this type of annuity. Probably exactly the type that it was created for. However, she's the only person that I have ever considered for this type of annuity because of the extreme nature of its terms. So I think it's fair to say that some annuities lend themselves more to more common situations than others. This particular one for me has just been a lot less common. However, there may be other financial advisors that were out there that work more often with folks where this type of annuity is a good fit. This example, among many more, is exactly why I thought that we should take a deeper dive into annuities and examine the most popular types and the pluses and minuses related to them. We'll not only look at the most invested in annuities today and why, but we are going to look at some of the details that you should definitely know a little about before you make any decisions on whether an annuity is a good fit for you or not. Things like, what does it mean to annuitize an annuity? What type of annuities are better for income and which for investing for conservative growth? What is a rider and why would you consider adding one to an annuity? What is a fixed account inside an annuity? What are indexing strategies and what should I consider with them? What are the different fees that I should look for in them? What is guaranteed inside an annuity and what is not? Just to mention a few. So it's our goal today to not only give you the basics when it comes to annuities, but also some of the details that make them appealing and unappealing depending on your goals and preferences. Okay, now that you guys have a clearer understanding of what we're going to cover today, before we jump into it, I'd first like to thank each of you for joining us today to discuss this highly sought after topic. My name is Brian Dougherty of PLC Financial Solutions, and I'm your host along with my beautiful, wonderful partner in business and life, Rachel Dougherty. Say hi, Rachel. Rachel will be, as always, our moderator for it. So she'll be handling all your comments and questions as we move along. Before we get started, let's take care of some general housekeeping first. If the screen is not big enough for you to read, you can click on the View Options drop down at the top right of your screen to make it larger. Also, you'll see that there are two boxes at the bottom of your screen. One called Chat, it's for your comments, and the other called Q&A for your questions. Please use them accordingly, and Rachel will respond to them in kind. Next, I'm sure that many of you are going to have questions about the material that as we go along. However, since we have a good bit to cover and only an hour or so to cover it, I'm going to ask you to put your comments and questions in those boxes below, because at the end, we will be staying for some extra time to cover as many of them as possible. However, if we don't cover yours, we'd be happy to answer it by either email or even a 15-minute Q&A phone call scheduled for another time. Rachel will be posting a link for you to schedule that at the end of this. Next thing, this webinar is being recorded and it will be sent to everyone who is attending tonight. So don't worry about missing anything. You'll have plenty of time to check it out again at your convenience. Also, because we want to make sure that all you guys are paying attention, and because we like you to have some fun as well, before we answer any questions, we have a 6-question quiz for you at the end. And the first person to answer each question correctly inside the comment box will win a $10 gift card to a store of your choice. So make sure you have a notebook handy to jot down some of the brief notes related to some of the bullet points that I will point out as we go along. Finally, it's my obligation as a financial advisor and a fiduciary to inform you of our RIA's disclaimer statement, which is that our investment advisory services are offered through Fusion Capital Management, an SEC registered investment advisor, and we only transact business in states where we are properly registered or are excluded or exempted from registration requirements. Also, SEC registration is not an endorsement of our firm by the commission and does not mean that our advisors have attained a specific level of skill or ability. And most importantly, all investment strategies have the potential for profit or loss. Whew. So now that we got that over with, I have one for you as usual. And this one I actually got from my younger son, Con. He said that he actually made it up himself, and we thought it was so good, I said I was gonna use it on our next webinar, right, Rach? So here it goes. What do you call a duck on drugs? A quackhead. I'm gonna have to tell everybody that that everybody liked my joke. So put a comment whether you like that Com's joke or not. But I guess I should probably keep my day job as usual. All right. Again, thank you all for attending today. We're going to have a lot of fun while we're learning some good stuff about annuities. Now, before we get too deep into the specifics of related to the different annuities, let's take a brief look at the history of annuities and the historical basic function of them. So I Googled when were annuities first introduced in America, and I got this. Annuities made their first mark in America during the 18th century. In 1759, a company in Pennsylvania, our home state, started annuities, was formed to benefit Presbyterian ministers and their families. The ministers would contribute to the fund in exchange for lifetime payments. However, it wasn't until 1912 that Americans could buy annuities outside of a group. another Pennsylvania company, the Pennsylvania Company for Insurance on Lives and Granting Annuities was the very first American company to offer annuities to the general public. Moreover, I also Googled, how did the first individual annuities work? And I got this. An annuity is a long-term investment that is issued by an insurance company and is designed to help protect you from the risk of outliving your income. Through annuitization, you purchase payments, and what you contribute is then converted into periodic payments that can last for life. Now, the key word in this last definition is annuitization, because one, it's where the name annuity came from, and two, it was through this process that a customer was able to generate an income for life. So, how is the word annuitization defined? There are actually several definitions, but the simplest one I could find was this. Annuitization converts an annuity investment into regular payments. Now, these payments can be made over the remainder of someone's life or over a certain period of time, depending on the payout options that they are offered and or chosen by an annuity. I added that last part. Okay, let's leave it at this for now, because I think that this lays enough groundwork for us to move forward at this point. So, what are the most commonly used annuities today and how do they work? Well, there are several different annuities that have been created to fill certain needs. The most commonly used annuities today are fixed annuities, also known as FAs, fixed indexed annuities, also known as FIAs, and variable annuities, also known as VAs. Furthermore, all three of these types of annuities can be classified in two more ways, which are immediate annuities and deferred annuities, depending on the customer's needs. This, of course, refers to whether an annuity is put into use right away, hence immediately, or at a later date, hence deferred. Now let's look at each of these annuities types and how they work. Okay, when it comes to fixed annuities, the basic characteristics of them is that they offer a fixed rate of return throughout the entire life of the annuity. This is the original annuity. It will guarantee a certain upfront rate of return, which these days is usually around 2% or less, unfortunately, on a long-term contract, and generally does not come with any income-based riders, which we'll explain a little bit more about in a little bit. So to get income for life from one of these, you usually have to annuitize the contract. Now, there is another type of fixed annuity that's out there today, though, and that does not offer an income option, but does offer very competitive short-term returns. And it's called a multi-year guaranteed annuity, or otherwise known as a MYGA, M-Y-G-A. They're mainly sold to compete directly with short and medium duration CDs and bonds. And they work very similar to them too, but they have historically higher returns than both. Actually, currently, as of yesterday, the range on a 2-year to a 5-year MYGA is anywhere from 2.1% for a 2-year up to 3% for a actual 5-year MYGA. And if you're really serious about it, think you get 3.25 on a 10-year. Now, as opposed to CDs, which for the same time frame are offering right now only 0.75% to 1.49%, which is roughly half the guaranteed yield. Now, also Treasury notes, which are the U.S. Treasury securities that have durations between 2 years and 10 years, are currently yielding 1.47% for a 2-year note, 1.82% for a 5-year, and 1.93% for a 10-year note. So you can see that MYGAs still are offering better guaranteed rates than their competition. Also, it's also worth noting that MYGAs do offer compound interest, just like CDs, as opposed to bonds that only offer simple interest, but might still be attractive if the guaranteed interest, also known as the coupon rate, is good enough. Okay, now let's move on to fixed indexed annuities. All right, when it comes to fixed indexed annuities, here are the basic characteristics of them. The interest they earn is based on changes in a market index, which measures how the market or part of the market performs. It is not actually invested in that index, but rather linked or mirrors it. The interest rate is guaranteed to never be less than zero, even if the market goes down, which is a fancy way of saying that the principal investment is always guaranteed. Although you should know that if the index that your money is linked to does zero return in any given year, and your money still doesn't grow for that year, it can still actually reduce by the cost of any fees, if any, that are part of that annuity. So it's always a good idea to make sure that if there are any fees involved, that they are worth taking on. Now, annuitization is an option for fixed indexed annuities if you're so inclined to go that route. However, the reason why most financial advisors would prefer an income rider over annuitizing a fixed indexed annuity, even though both will provide income for life or for some other designated period of time of the annuitant's choosing, is because an income rider will provide a guaranteed minimum income amount that will be paid in the future, which makes it possible to plan in advance based on that number. Now, on the other hand, with annuitization in a fixed indexed annuity, because you're not getting a fixed rate of return, you don't find out how much you're going to get until the time when it is exercised, which makes it much less possible to plan in advance for. Finally, these days, many fixed indexed annuities have been created just for the purpose of investing, due to the principal of protected moderate to conservative growth that they provide. However, these types of FIAs generally do not have an option to purchase an income rider, but they still could be annuitized if someone wanted to do so. They're sometimes also referred to as investment annuities or bond replacement annuities as well, and they've become very popular over the last 10 years or so, since government bonds and CDs have yielded so little for so long. In fact, at one time, long-term U.S. treasuries could be relied on for an average of roughly around 5%. But since January of 2008 until today, they've only averaged around 1.9%, which is a significant loss in yield for a long-term investor, especially if they're retired and need to play it safe. Conversely, based on simulated returns from 1927 to 2016, it was found that net of fees, fixed indexed annuities had an annual return of 5.8% compared to 5.3% for long-term government bonds over the same period of time. So it's easy to see why FIAs have become a natural alternative to investing in government bonds over the last few years. The final type of annuity we're going to discuss is a variable annuity. So when you purchase a variable annuity, the money you pay is actually invested or actually allocated to an investment portfolio. So you'll have several options for investing the funds in that portfolio. And these options are called subaccounts. And they can include stocks, bonds, money market funds, stable income value mutual funds, and other types of investments as well. Also, if you invest in a variable annuity to later annuitize it for an income for life, the amount of the income you receive will rise or fall depending on the performance of the portfolio. So these are not for people that are looking for or need a consistent income amount every month. However, they could be for someone who has maxed out all their other sources of tax deferred vehicles like IRAs, 401ks, and Roth accounts, and is looking for another tax deferred account that has no limits on the contribution amounts. Although I must say the federal government still charges a 10% early withdrawal penalty on them for anyone who withdraws from them before the age of 59 and a half. So now that you have a better understanding of the three main types of annuities and how they work, now let's talk about some of the other things that you should know more about when it comes to them. These are things that may or may not apply to any given annuity, but are universal in the sense that all insurance companies that sell annuities may or may not include them in one or more of the policies. The first thing on that list for us to discuss is fees and how they may or may not be incorporated into a given annuity. And you heard me right when I said may or may not be a part of it, because some annuities actually do not charge any fees. So let's take a deeper look into that. Okay, when it comes to fees and annuities, there are several types that are common when it comes to them. Let's start with fixed annuities. Now, they usually do not charge upfront or annual fees, but instead they'll reduce their guaranteed rates as compared to what the market bears, which will allow them to apply the difference to any internal fees that are incurred. Now, as far as fixed index annuities are concerned, they too usually do charge upfront. They too usually don't charge upfront or annual fees based on the base contract. But instead, they charge rider fees, and the riders are used to enhance their returns, sometimes dramatically, so much so that it almost doesn't make sense not to purchase them. For instance, I've seen income riders that offer a potential increase in income that is linked directly to the same index that the cash account is linked to, thus making it possible for the annual income to increase beyond what inflation bears, or even at the rate of inflation, which is also offered, which is a very valuable feature, one that is very difficult to turn down. You'll see income annuity fees that are usually around 1% annually. There's also liquidity rider fees that are usually around 1% to say 60 basis points, and even indexing strategy fees for historically well-performing, actively managed indexes that are offered that can run anywhere from 1% to 1.75% of any assets that they're linked to. This is just to mention a few because there are many types of riders available and associated with FIAs, and we're actually going to discuss several of them shortly. Next, when it comes to the fees related to variable annuities, they get a little bit involved. Here are some of the most common fees inside VAs. The first is called the mortality expense fee, also known as the M&E fee. This is an asset-based charge applicable to only the variable subaccounts that usually can't increase during the life of the contract. It covers death. It covers death benefit costs and the guaranteed ability to annuitize at a rate established in the contract at the time of purchase. That's a pretty good, that can be a pretty good thing. This fee can cost up to 1.5% of the account value annually. So it can be pretty steep. There's also the administrative fees. This is also an asset-based charge covering the maintenance of the contract, including record keeping and other administrative fees. You can expect to pay up to 0.3% of the account value annually. The investment expense ratio fee. This is an investment advisory or management fee. It also is an asset-based charge used to pay the portfolio managers of the sub-accounts. And you can expect to pay up to as much as 2% of the total value annually. Now, there are the three that are usually built into every variable annuity, but there are some optional ones that you see quite a bit as well. And the first one is an income rider fee that's called a guaranteed lifetime withdrawal benefit fee. This is an income rider that is similar to the fixed indexed annuity income rider. Annuitants can expect to pay for this one upwards of about 1%, same as it is with an FIA annually. Another is called the enhanced death benefit rider fee. This is an optional estate planning rider to protect the annuity owner's beneficiaries' investment and can cost up to 0.5% of the account value annually. So these are the most common fees associated with the types of annuities that we've discussed. Now, let's take a look at the most common riders now that we've seen in many of them. So, but before we do that, before we get into that, let's define what a rider is. Can also be referred to as a floater or an endorsement. And simply put, it is an optional add-on to an insurance policy. That's the definition. It's just an optional add-on to an insurance policy. Also, so you know, its opposing cohort is something called a waiver. And it, simply put, is the surrender of a right or privilege within a policy. But we're not really going to get too much into that. We're only going to mention really one way. So here's our list of the most common riders that we've seen. First, the guaranteed withdrawal benefit. It provides an immediate withdrawal from the invested balance without having to annuitize the investment. It's usually a predetermined percentage of the assets, somewhere between 5% and 15% of the total investment. There's also a lifetime income benefit rider. It guarantees that you'll receive regular income payments from the annuity that will continue for the rest of your life, even if the actual balance of the annuity is fully depleted. There's also a death benefit rider. It guarantees that your heirs will receive at least the amount of the premium that you paid for the annuity, but usually no additional return that is made on it. There can be a long-term care rider. This rider provides for the reimbursement of long-term care related expenses up to a predetermined amount over a predetermined time period. The time period can be both finite and infinite, depends on how the policy is constructed. There can be a cost of living rider, which will provide for increases in the monthly payments based on a measure of inflation, which can be based on either the CPI, Consumer Price Index, or just a specific percentage that is agreed upon in advance, which I usually see them somewhere between 3% and 5%. And there can also be a refund or a return of premium rider, which provides for the return of invested funds to the named beneficiary in the rider in the event that the annuity owner dies before the principal value of an annuity has been paid out. Some may even include interest on the invested amount, but most don't, ones that I've seen anyway. Now, here's the one waiver. There could be a waiver of premium rider. These are most commonly seen in long-term care and disability policies. It provides for premiums to discontinue for a certain period of time when certain conditions are met, like a disability or not being able to perform 2 or more of the activities of daily living. However, it is a short-term, if it's a short-term disability, once the insured is no longer declared disabled, then the premium will no longer be waived. There can also be something called a liquidity rider. I mentioned that in the last slide. This rider provides that after a certain period of time, usually somewhere between 2 and 4 years, the full premium can be liquidated without, although you can't get your interest back, minus any withdrawals that were made. And you can do this without surrender charges, which we're going to discuss in a minute what they are. Another one's called a commuted payout rider. It enables you to withdraw a lump sum from your annuity without any surrender charges applied. It's always predetermined. It's always a predetermined percentage of the cash accumulation, just like the other one I mentioned. That was between 5 and 15%, although sometimes these can be larger percentages. Guaranteed, next is a guaranteed minimum accumulation benefit rider. Some of these get pretty wordy. This rider is most commonly seen with variable annuities, and it guarantees that the minimum amount received will be the dollar amount invested in the contract, or the gain in the value of the contract, whichever is higher, between the time it's established and when you begin the income payments. Finally, the last most common one that I've seen is a guaranteed minimum income benefit rider. It ensures that the annuitant will receive a specific income payment, regardless of the performance of the annuity from the time that the contract is put in place. Okay, so there's some of the more popular riders that we see, but there are many more, and actually always plenty new ones that come along that you see from time to time with the different insurers. So now let's discuss some of the various options available for interest to be attained in these annuities that we've been looking at. There are several different options in which assets that are invested into these various annuities can grow or be credited, which is the technical term that is used when discussing the return that annuities get. First, in fixed annuities, like we discussed before, there's a guaranteed rate of return that is predetermined upon purchasing it. The assets are then invested into the insurance company's general account, which normally is invested into either government bonds or the highest quality corporate bonds available. Next, when it comes to fixed indexed annuities, there are usually a dozen or so options to choose from when it comes to pursuing growth on your money. The first of which is called a fixed account, and it usually is the equivalent of investing into short duration bonds or CDs. Today's ranging being anywhere between 1% and 2%. So it's not really all that exciting these days. At one time could be as high as 4% or 5% actually. The remainder are usually variations of 5 or 6 different indexing strategies that are based on either actual stock market indexes like the S&P 500, NASDAQ, and the Dow Jones, or have been created just for the use in some indexed annuities, usually by the insurance companies themselves and or in conjunction with a third-party mutual fund company, money manager or consulting firm like, say, Morningstar or American Funds, Fidelity, PIMCO, any number of them. Now, when it comes to these indexing strategies, they're usually named after the index in terms that they offer. Then they'll also be given terms related to how the return that the index generates will be applied. For example, if you look on this chart here, that says anniversary informational on the top left. The second line down under the fixed account, it refers to the indexing strategy that is offered as the P2P S&P 500. This is the annual point-to-point S&P 500 index that they're offering. It then proceeds to show the terms that they are offering it at for the upcoming year. As you can see, the starting point is at 4,300.46. That's where the S&P 500 index was on the day of the anniversary. There is no index margin or spread, it's called. It has a 20% participation rate, this particular one, which is not too good. Which means that whatever the index does, the annuitant will receive 20% of that. So if it did 10%, you'd get 2%. If it did 20%, you'd get 4%. Then there are no strategy fees, caps, or interest credit factors applied to this particular indexing strategy that's being offered. So as you can see, each available indexing strategy comes with its own index it's related to and terms as to how it will be credited, which is either every year or every 2 years. And whether it offers a margin, like I said, which is a spread, how that works is if the S&P were to get 500 or get 10, or you were to get do 10% and they had a 3% spread, they deduct 3% from it and give you 7%. Or then it would be either a participation rate, which is up to that specific percentage and nothing beyond that they'll give you. A cap percentage, which means that they will only apply a return up to that rate, nothing higher than that. So if they're giving you 3%, you'll get up to 3%. If the S&P does 4% or 5 or 6, you'll get nothing above that 3%. Or whether they are charging a fee for that specific indexing strategy. You can see all that from left to right. It's all laid out for you in the annual statement that is received every year by the annuitant. One last thing I must mention when it comes to fixed index annuities. Even though the principal investment is always guaranteed and can never go down due to market or index performance, which includes the gains they earn as well, it could still lose value in a year when it gets a 0 return or credit if it has a rider fee that is charged to it. So if you invested $100,000 in an FIA and the first year you made $10,000 in return, but the second year your index actually had a negative return, your account balance would stay at $110,000 based on the index. However, if you had a 1% income rider fee, that $110,000 would actually be reduced by $1,100 to $108,900 due to the fee being deducted. I always like to point that out in the comments. Now, when it comes to variable annuities, they actually do invest the assets into various types of market-based investments, like mutual funds, money market funds, stocks, and bonds, etc. But as I mentioned before, they are referred to as sub-accounts instead of funds or stocks or bonds. Of course, these sub-accounts work just like any other market-based investment. The principal can be depleted as a result of the performance of the sub-accounts. So it is possible in a variable annuity to lose the full value of the account if someone was making withdrawals at the same time that the market had a major correction. Because remember, this type of annuity is the only type where the principal is not protected from the performance of the investments inside of it. Now, the last thing I want to mention about indexing strategies that are offered with fixed index annuities is that you have to keep an eye on them every year or two, depending on when their credits are applied, because the insurance companies are not obligated to offer you the same terms on them once this occurs. they reserve the right to change those strategies based on whatever current market conditions are. This means that the terms of the indexing strategy that your money is gaining interest from can either improve or worsen based on current market conditions. Now, to be fair, though, it's been my experience that all the insurance companies that I've dealt with want to offer the best returns to their customers, so rates move up and down move up as much as they move down. It's purely market driven. Also, at the time of these periodic changes, there may be some new indexing strategies that the insurance company is offering that have better potential returns than the ones you started with. So you really need to keep a close watch on these year after year, because you only get a 3 or 4 week window right around your anniversary date for you to make changes to them, which most of my clients know that I recommend doing from time to time. Okay, that covers the options for growth in these annuities. Now let's move on to discuss the penalties that can be incurred with them. Hold on, I need to get a sip here. I'm going too fast, right? All right. When it comes to the penalties inside of annuities, it's really pretty much straightforward. Every annuity has what is called a surrender period. This is a period of time that lasts usually between 1 to 14 years, at least the ones I've seen, depending on the type of annuity it is. Some are a lot shorter term than others. During that time period, if you withdraw more than what is known as the penalty-free withdrawal amount, which is usually between 5 and 15%, most that I see are around 10%, then you will incur what is known as a surrender charge. This is a charge that is only applied to the amount that you withdraw above the penalty-free withdrawal percentage. So if you had $100,000 in annuity and it had a 10% penalty-free withdrawal percentage, you could take out $10,000 without a penalty. But if you took out $12,000, then the extra $2,000 would incur a penalty to be deducted from your account, not your withdrawal amount. However, after the surrender period's up, you can take out as much as you want, whenever you want, and there's no longer any penalties involved. Now, the only other potential reduction that could apply to withdrawals that exceed the penalty-free withdrawal amount is called a market value adjustment, or MVA. Now, however, this could actually also cause an increase in your withdrawal amount because it's based on whatever current bond interest rates are compared to when you made your investment into the annuity. If rates are down from when you purchased it, then your withdrawal amount will actually be increased. But if they are up from that time, then this will decrease your withdrawal amount and thus cause you to need to withdraw more to get a specific amount out at that time. Now, the last penalty that could occur and is completely unrelated to the individual terms of the annuity between the insured and the insurer is if someone who owns the annuity, hold on, I got to switch to my other one. I'm running out of water down here, Rach. Getting parched. If someone who owns the annuity is under the age of 59 and a half and decides to make a withdrawal, since it's an investment vehicle that the government allows to grow tax deferred, just like an IRA or a 401k, a 10% early withdrawal penalty will be assessed by the federal government. All right, that covers all the potential penalties. Now let's move on to what's called a bonus and discuss whether it is real or not. So what is a bonus inside an annuity? Well, it's simply extra money that the insurance company will credit to your accounts in order to boost certain accounts and income values it's offering. I get it. It kind of seems a little too good to be true. And to some degree, that's actually true. However, to explain bonuses better, what I tell people is that bonuses are used by insurance companies to entice people into investing into whatever specific annuities and life insurance related products that they're looking to push at any given time. They do this when they're trying to gain market share with different products. Then once they accomplish that, they always discontinue the bonuses. So they're not always available. That's why I tell my clients to get them while you can. It always breaks my heart when they go away. Okay, so when it comes to bonuses, there are basically three types that the least I've seen. The first is called a premium bonus. And this definitely is real because it is actually cash that they will add to your cash accumulation account. And at a later date, it can be accessed when you withdraw your money after the surrender period. The second is called an income account bonus. And it only adds cash to what is called the income account on annuities that have income riders. This cash cannot be actually accessed in a lump sum to withdraw. So in some ways, it isn't actually real. It basically just serves to raise the amounts of your income rider payments whenever you choose to activate them. So it is real that you will receive higher income payments as a result of them. The third and final bonus is something that's called an income account roll-up. This is a guaranteed rate of return that is again only applied to the income account of an annuity with an income rider. These roll-ups can range from, I've seen them anywhere from 3% to 10%, and can be added for up to 20 years prior to activating the income rider. Then once the income rider is activated, they stop being applied to the income account. Again, these just serve to provide a higher income payment at a later date. So, if you're not aware of how most income riders work, let me explain that once someone purchases an income rider, there then becomes two different types of accounts that are tabulated within the annuity. One is called the cash accumulation account, which is your actual cash that is applied interest credits based on either the index it's linked to or the sub-accounts it's invested into if it's a VA. The second is known as an income account. This is the account where your income rider payments will be withdrawn from. This is also the account where the income account bonuses and guaranteed roll-up rates are added in order to beef up your future income rider payments. All right, that's enough about bonuses. Let's move on to our last detail, to the internal workings of annuities. And that's called payout percentages. Now, the last piece of the puzzle that you definitely have to know when it comes to income rider based annuities is what is the payout percentage at any given age. This is a huge deal because an insurance company can give you $1 million income account bonus. But if they're only offering a 1% a year payout percentage, then you're only going to get paid $10,000 from it for the rest of your life. $10,000 a year. But if they're offering a 5% a year payout percentage, then you'll be getting $50K a year for the rest of your life. That is a huge difference. And you can see it in the charts below that these two different insurance companies offer different payout percentage, different payout percentages at the same ages. The one on the left at age 65 offers a 4.5% payout percentage versus the one on the right offers a 4.1% payout percentage. And this is for a joint annuity, which basically means it will pay out to the first annuitant, and then If in a married situation, if the first one, when the first one passes away, it will also pay out to the second until they pass away. That's roughly about a $2,000 a year difference. Remember, every little bit adds up. Also, as far as annuities go, these two are actually pretty close to each other. I've seen others where they pay out, where the payout's 5%, and the others on another one, it's 4% at the same age. That could be a $5,000 a year difference. So it can make a big difference. So don't forget to always look at the payout percentages, because inside income-based annuities, it is the king. Okay, now that we've looked at some of the most internally important things related to the various types of annuities, let's talk about one of the most important externally related things. And that's the rating of the insurance company that you've purchased your annuity from. So when it comes to insurance company ratings, they're based on the company's ability to pay its claim. So the higher the rating, the higher the volume of claims that a company can pay at any given time. However, when it comes to annuities, the length of time you will be committed to it will depend on your purpose for investing into it. So if you're investing into a 3-year multi-year guaranteed annuity, also known as a MIGA, the ones I was talking about earlier, and a company that has a lower rating is offering a higher rate on your money, then they might be a viable consideration, because 3 years is not a long commitment. So in that situation, a B-rated company would definitely be worth considering. However, if you're looking to invest in an annuity that can provide you an income for life, which is obviously a much longer commitment, then you should consider going with at least an A-rated company, because they're more likely to stay in business longer than the B-rated company. Even though it isn't very often that A or B-rated companies go out of business. I've never seen it, but it's possible. The two most popular insurance company rating companies are AM Best, whose highest rating is A++, and Standard & Poor's, whose highest rating is AAA. All right, at this point, we've discussed what are the most common annuities that are used today, and what I think are the major considerations when it comes to them. So now let's take a look at some scenarios that I've used annuities for and why. Okay, folks, these numbers are from an actual client of ours when we first met her 2 years ago. This is Sue Smith. Of course, we changed her name for privacy's sake. You can see that she had a total of $328,000 at that time. And she was age 61. She's planning on retiring at age 67. And at that time, her Social Security will be approximately $2,991 a month. And as you can see, she does not have a pension. Now, what stands out the most in this scenario is that her monthly expenses are going to be more than her monthly Social Security payments. So her expenses are going to be more than her income. Not much more, roughly around $459 a month more. And this is what we call an income gap. As soon as we see this, we automatically think about trying to fill that gap with an income annuity, if we can. And that's exactly what we did with her. We used around half of her assets to produce right around $900 a month to fill that gap. You're probably thinking right now, why didn't you just buy an annuity that would have filled the gap exactly? The problem with that is that in our financial planning software, we have her monthly expenses programmed to increase by 3% every year. So when we ran the numbers for an annuity to just fit that gap, it failed to provide enough income long-term to fill it. In fact, this particular income annuity also has a market-based increase that is applied to the payment annually based on how well the indexes that are linked to it perform. We factored it in to increase by approximately 3.88% a year, which is based on the 10 worst years of the last 20 years of historical performance from it. So now let's take a look how it played out inside of our retirement planning software. Okay, how this works is that we first had to enter all of her personal information into our financial planning software. Things like her date of birth, desired retirement year, amount of Social Security, pensions, if she would have had one, her fixed expenses, her estimated one-time expenses like a new car, vacation, holidays, home repairs, etc., her debt, like mortgages and credit cards, school loans, etc. Also, the amounts that she has in each of her investment accounts, like 401ks, IRAs, brokerage accounts, etc. And then also their long-term returns that we were able to estimate. Her estimated, we also estimated, we entered into it her estimated effective marginal tax rate, which we ran in our tax software. All that information was entered into the software before we could press one button that is called the what if button, which then tells us, based on what's called a Monte Carlo simulation, what the percentage chance of success that she has for her portfolio to last into her life expectancy, which in this case was 84 years old, according to government mortality tables. Well, as you can see, based on the photo on the left, when we did that, it told us that her portfolio had a 78% chance of it lasting. So because she had that income gap, we decided to implement an income annuity that was available to us at that time. And once we did that and retested it, our software was reading that her money had a 100% chance of lasting. This was how we knew definitively that the income annuity was a good choice for her. Now, it does not always work like this. And it does not always work as well as this. It depends on the size of the income gap. And if we can find an annuity with an income rider that pays out enough to fill the gap without costing too much to do so. Market conditions usually dictate that for us. So income gaps are definitely one of the main situations we look for when considering an income annuity. But it is definitely not the only situation where an income annuity should be considered. All right, now let's move to our second and final scenario. This one discusses when a good time to consider an investment-based annuity is. Okay, this scenario was also from another couple that became clients not long before the last client from scenario one. He was age 65 and she was age 62. They had a total of $670,000 in assets. Their total combined Social Security and pensions, which they had, added together were $6,300 a month. But this time, their total monthly expenses were less than their total combined incomes. What it is. This is a situation where there was no income gap. So then one of the things that we'll look for is how well their portfolio performs under a market-based stress test. When we tested their portfolio to see how well it would hold up if there were two major market corrections over the next 20 years in their retirement, which is about the average, we found that it would hold up, but that it wasn't going in the right direction because of the risk level of the investments that it was invested in at that time. So the challenge with pulling back the risk of a portfolio these days is that the traditional way that we would do this in the past was to just move a large percentage of the assets into high quality government bonds and corporate bonds, which historically average right around 5% since their inception in the late 1800s. The government bonds, because we'd always stay with them as much as possible. And they did all the way up to around 2011, when they started to go downhill fast. Now, over the past 10 years, long-term government bonds have only averaged a little over 1.9%. So in order to make up for this, many financial advisors have started to incorporate fixed index annuities to make up for some of those long-term bond deficits. In fact, not long ago, some studies were published by a pretty reputable professor from Yale named Roger Ibbotson, where he back-tested both bonds and fixed indexed annuities all the way back to 1926. And he discovered that FIAs had overall averaged 5.81% versus 5.32% for bonds. However, that study was done in 2016, and it didn't include the bond rates for the last 6 years, which have been the lowest in the entire history of bonds. That all being said, Ibbotson also made a recommendation that at that time, for everyone to start adding FIAs into their portfolios as a third non-correlated asset class, meaning that the performance of the FIAs did not directly go up and down at the same rate as stocks and bonds did in their respective markets. So that's exactly what I applied to this client's portfolio. It ended up being 40% equities, 30% short bonds, and a combination of short government and corporate bonds, and 30% to a fixed indexed annuity. Let's take a look at how that combination of asset classes played out in our planning software when compared to what they had. Well, as you can see, the photo on the left, which was their original portfolio, has a steady decline of assets up until their life expectancy. And the photo on the right, which was the new 40-30-30 portfolio, had a steady incline of assets. In fact, when it declined at their life expectancy, the assets were around 400,000. When it inclined with the new portfolio, they are upwards of $1 million. This is mainly because adding the FIA to their portfolio allows it to reduce the overall volatility and downside potential. At the same time, it brings back to the portfolio a higher upside potential than it would have had these days if it was just in 60% bonds. So after testing and comparing these two different asset allocations, we knew that the implementation of the FIA was going to give their portfolio the additional protection and potential performance that it would have been lacking without with only bonds as the alternate investment to the equity portion of the portfolio. That's why we ended up implementing the FIA at that time. Well, folks, that was our last scenario. I can't tell you how much fun I had presenting them to you, and I hope that you now have a better idea of I hope you have a better idea of all the considerations that go into whether an annuity is right for a retirement plan or not. So that concludes the learning portion of our webinar today. We sincerely hope that this annuity information and considerations that we have discussed with you today are as helpful to you as they are to us when putting them into a plan. Also, before we jump into our 6th question quiz and our Q&A for it, I want to make a special offer to everyone that is attending our webinar today. I usually charge $495 for a full annuity review analysis like we've discussed today. But for everyone here with us on this webinar today, I am offering a complimentary, no obligation annuity review analysis if you book it on my calendar before midnight tonight. However, if for some reason you can't book it tonight, I will, or you want to think about it, I'll still offer you a 50% discount if you book it by Friday this week. Also, I want to take a minute to explain a little about what the review entails and what you can get out of it. So this is what it entails. First, there's two ways we can actually meet to do it. The first is online using Zoom, which is almost just like how we are doing this webinar. But instead, we'll both be able to see and hear each other, and it will be completely private. Second, or we can meet in person. That's a novel idea these days, Rach. In person at our office in Fort Washington, PA. It's just off the PA Turnpike. I'm fully vaccinated and boosted, and I've already had COVID over Christmas break, fortunately or unfortunately. So I'm not worried about it if you're not. Also, in order to schedule it, Rachel will be putting up a link to the comment box in the comment box right now for you to book a 60-minute meeting on my calendar. If you do so before midnight tonight, the review will be completely free of charge. And if you do so before this Friday, it will be 50% off. Second, the review itself is a two-step process. We would meet to gather all the information that I'll need to do the review. Secondly, we would meet a second time to go over the results of it. Finally, what you can get out of this is a clear understanding of whether any of the annuity considerations that we discussed today can be applied to your plan in a way to help improve it. Okay, folks, now we're going to jump into our 6-question quiz and our Q&A session before we wrap things up. All right, you ready, Rach? Okay, get ready, everybody. Put your answers in the chat box. Name one of the 3 annuities that we discussed today. Name one of the 3 types of annuities that we discussed today. Anything, Rach?
It looks like Amphi got it. Fixed annuity.
Hey, I love it. You're racking them up, Ann. She won the last time she was on. Ann's one of our clients. All right, yo, Ann, if you could, please put in the comment box where you would like your $10 gift card to be from. Okay, number 2. Name one of the 2. Now, this actually is going to get a little tougher this time. I hope we get someone to answer this. Name one of the 2 other main classifications that the 3 annuities we discussed may be classified as. So the 3 we discussed can all be classified under these 2 other classifications. I mentioned them in the beginning. You remember them, Rach?
I do.
Okay.
I think you're asking an awful lot, Craig.
Am I? Remember, it had to do with.
Oh, wait, there it goes. And again.
Really?
Immediate deferred, right?
Oh my goodness. Good job, man. You're
She
killing
must
it.
have it. She was taking good notes.
She was. Okay. Which type of annuity is linked to an index for the purpose of gaining growth? Link. That's the key.
I'm gonna go with Ann got it again. Fixed indexed.
Yes. Oh my God. Come on, people. And just beat $30. All right.
Marty was close.
Was he?
Yep, you got the fixed, but not the fixed indexed.
Oh.
That's the trick.
Okay. Which type of annuity has an M and E fee? An M and E fee. Mortality and expense. Remember, I said it could be as high as 1.5% in some of these types of annuities.
Let's see, well, Ann said variable index. Is it the index or is it just, does that count or no?
That's close. It's close. Not exactly. I'll give you a hint. It's not the first two we discussed. It's the last one.
Oh, Ken Hupman got it. Variable annuity.
Yes, good job, Ken. Okay. What is an option? What is an optional add-on to an insurance policy called? An optional add-on.
Who got that? Oh, Lesha got it.
What is it?
Rider.
Yes, great job, Lasha. All right, final question, drum roll. Name one, or should we have like the music, like ding, 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 ding.
We'll have to note to self at that next time.
Yeah, name one of the two types of accounts that a bonus can be added to. Oh, I know this is a tough one.
These
Name,
are hard questions this time, Brian.
I know, I just, that's close. That's very, very close, Lasha. It's actually the premium bonus goes into the account, one of the accounts. And it's really just, it's the account.
Did Ann get it?
What?
She put input income. That's one of the accounts, right?
Yes, income is one of them.
Mm-hmm.
So Ann got that sixth one too, huh? Uh-oh, and the other one's the cash accumulation account, but I would have taken cash account. All right, wow. I pushed it all. I pushed it a little hard this time, Rach. I just
You did.
a slave driver on this one, but I thought go for it. Yeah, look, we got the answers.
Yeah. Okay. So now you ready for a few questions?
Yeah, let's hit some questions then.
Okay, hold on a second. Let me get, there were some up here. There's a couple in this one. There's one that says, one person was saying, I have to retire early due to health problems at age 55. It says, how can I use my annuity without big penalties?
So I want to make sure that because quite a few, some of the attendees we had have been union members, and some of the unions that we've done some webinars for, and they have accounts at the unions that are coined as annuities, but they're actually more like like a they're probably a 457B. That's what they usually are. They're for nonprofits, which is like the equivalent of a 401k or what have you. So, but either way, if it's a traditional annuity that they purchased personally, there are some exceptions for the 401k type of annuities, or accounts. I hate to call them annuities. They're not really annuities. They just coined them as that. And there are some exceptions they'll make for those types of accounts if you're 55 and older, based on certain ways you can take payments from them. But not knowing the terms, I don't know that it would allow a payment for life or not. It may just allow a payment until the money ran out, depending on what type of annuity it was. On a traditional annuity, the type we discussed today, I believe if it's an IRA type of annuity, they may make those same exceptions, but I'd really have to see the case to see if any of that applied, if it was the type of annuity that we discussed tonight or not, and if it was qualified or non-qualified money that was invested into it. So that's a little, you need a few more details to answer that completely.
Okay.
It can be possible. Can be possible.
Okay, well, another one is if I don't have a pension coming to me, should I definitely get an income annuity?
That's a good question as well. And I'm going to tell you, not always. Okay, you may have an income gap, you may not. Depending on if how much in assets you have, it may make sense or not. There's a certain sweet spot that, in terms of the amount of assets and the income gap that's there, that I think it makes a lot of sense to do it. But some people with assets that are, say, of a certain amount that are higher, there may be some other ways to go about it that may actually be more beneficial. There may be some other annuities, but maybe not an income annuity, and maybe not an annuity at all, depending on the amount of the assets.
Okay, you're right. Can you do a couple more?
Mm-hmm.
2 more? All right. I am afraid to lose my retirement savings in the stock market. Should I consider investing into an annuity?
Well, that's always one of the main reasons why people do. I would tell somebody that I would never, ever invest all my assets into an annuity. Okay, that never makes sense. Okay, the diversification is always king, in my opinion. But depending on your risk tolerance or not, would depend on how much, but it can be a viable alternative to help protect you from the stock market. So that's kind of what their main use is.
Okay. One more?
Yeah, sure.
Okay. Do you think annuities are too restrictive for the average retiree to invest in?
Now that's a good one. Okay, so I say some people think they are. Some people think they are. Some advisors think they are. But I guess, given the current market conditions, where it's very difficult to get safe return on your money anymore because of how low bonds and CDs are, it could be a trade-off, again, to take a percentage of your assets and invest them into like an annuity of sorts, in order to pick up some of that return that was lost on that end. But I'd say it would be a delicate balance. I don't, some people, they just hate the restrictions of them. And I understand that, when you're making choices around your portfolio, there's really no perfect investments that exist out there today. So you're usually going to have to make some choices related to all of them. And some of the restrictions, can be a trade-off.
That's it. I saw there was that other one in the Q&A that you were typing the answer. Are you gonna just type that? Or are you just gonna answer that one on your own?
Yeah. I
That
think
one's a
I
little bit
just have
different.
the answer to that. No, I'll reach out.
Okay, just want to make sure. I don't know if you wanted to go over that one. Okay,
All right.
that's it. That's all I have.
All right. So also too, here's our resources that we used for the content of this portfolio of this webinar. Rachel's also going to put them up in the comment box so that, and we're going to leave this webinar format open for about a half hour after we leave it. So you can go into the comment box and copy and paste these references if you want, the links to the meetings, the 60-minute meeting, and the 15-minute Q&A phone call. All of them, you'll have plenty of time to go back in. You can copy and paste them, put them into an email them to yourself or into a document, what have you. All right, folks, that concludes our workshop for today. I just want to thank everyone who attended for being the type of people that care enough about themselves and their family to spend their precious time learning about this important topic. I truly commend you for that. I want to remind you that if you have any questions related to this topic we've covered today, or our offering of the complimentary no obligation annuity review analysis, or if we did not answer your question, which it looks like we did, in the comment box, or really anything else for that matter, you'd like to discuss it with me further or Rachel will also be putting up a link for a complimentary 15-minute Q&A meeting with me, so you can schedule that for a time that is convenient to you as well. That all being said, that's all for tonight, folks. On behalf of my beautiful, wonderful partner in life and business, Rachel Dougherty, and myself, Brian Dougherty of PLC Financial Solutions, located in the Fort Washington, PA area. Also, you can reach us at either 215-804-9708 by phone or at info@plcfs.com. Or to make it even easier, just go to our website at plcfs.com and all our information is always there. Also, please mark Tuesday, March 22nd, 2022 at 7 p.m. on your calendar for our next webinar. Our topic next month will be Social Security strategies. Remember, we do them on the last Tuesday of every month. Have a great rest of your week, and we'll see you then. Good night, folks.
Good night, everybody. Thank you.